Well, we're back with you to keep an eye on your ag commodity trade. We're inviting in some extra help from Brian Hoops, the president of Midwest Market Solutions in Springfield, Missouri. He joins us right now. Brian, let's take a look at our current trade, and I want to get your thoughts on what is driving the markets here today, if anything. On the corn market right now, we are maintaining a weaker tone, but we are coming off of those earlier lows this morning. We're almost back to unchanged now. March corn down just a half. Last trade, 378 3/4, right in the middle of our trading range today. On the July, we're down a half. December down just one tick now at 402 1/4 per bushel. On the soybean market, on the soybean March, we are down a penny and a quarter at 917 1/4. Earlier, right after the open, we went down about 3 or 4 cents, and we bounced back off of that now. July down 3/4, and we have September down a penny at 951 1/4. On the wheat market today, we have Chicago's March contract down a penny and a half at 524 1/4, while July is down 2 3/4. And in Kansas City wheat, we have the March down a penny and a half at 509. Meanwhile, July down 3 1/4 at 523 1/4. Couple of things here, Brian, as we begin our discussion on the grain trade. In China, interesting, they announced all these purchases last week and over the weekend, and then we got the overnight confirmation this morning. But their markets are closed this week, right, for the Lunar New Year?
Yeah, that's my understanding, is so that their markets are closed and they're on holiday for a period of time. And we may get one more announcement on Wednesday morning yet. I don't think we're done with the announcements. It was expected to be a total of 5 million metric tons, and we're up to about 3.5 or 3.6 million. So we're still looking for some more sales to be put on the books, but market's really not having much of a way of effect here with these sales. We are more reaction to weather forecasts and changes in South American production numbers. Very narrow ranges for both corn and soybeans, which is not unexpected going into what should be a pretty volatile report on Friday morning.
So it would appear that 2.5 million tons that was mentioned over the weekend must be part of that larger 5 million package that they were talking about last week then?
Yeah, absolutely. This is not new news to the market or any fresh news for the market to digest. That's why we're seeing lower prices. This was traded already on Friday when the rumors were surfacing that China had made another token purchase. That 5 million metric tons was a similar amount to what they said they would purchase after the G20 summit as well. Really, that's seen just as a good faith effort towards U.S. relations.
The new weather updates for South America show rain moving back into the northern part of Brazil, where it has been so dry. Actually, northern and eastern Brazil, I believe, and they say that should increase crop prospects for the soybeans and the second corn crop, the safrinha crop there, and that is putting some pressure on the trade. Do you agree?
Absolutely. It's going to continue to put pressure on this market. We've got a very narrow range here in corn and soybeans. Corn's been traded in about a 6-cent range since January the 23rd. Looking to break out of it one way or the other, we may try and break out both ways on Friday's reports. Trade is looking for a small reduction in corn and soybean yields, which is given our yield prospects last fall and the fact that 4 out of the last 5 years we've seen lower yields from the November report to the final report. If we see a lower production number and a quick rise in the markets, we may see a lot of hedging come into the marketplace after Friday's reports and beat this market back down. It is based off of those numbers that you were talking about, an increase in the size of the corn and soybean crops in South America.
And we're getting into that time frame where it's the annual bidding for acres between now and planting season. So let the beat go on. All right, thank you, Brian. We'll come back in a moment and we'll analyze the latest in our livestock trade as well with Brian Hoops right after this. Let's go back to our discussion with Brian Hoops of Midwest Market Solutions in Springfield, Missouri. Interesting dynamics in the cattle market here today, Brian, where we have the live cattle going one way and the feeder cattle going the other way, at least this far in the day. First of all, on the live cattle board, let's take a closer look here. Now, we've got some decent strength on the nearby contracts with the February now 90 higher. It's at 126.63, and only one tick off our high of the day. The April contract, $0.50 higher at 127.50. June up 22, so the gains get less as you go further out, and in fact, they actually go to the minus side when you get to August. They are down 30, and October down 40. So looking at the feeder cattle side of things here, it's a whole different story. We're lower all across the board. March feeders down 78 at 143.45. April down 72 at 145.10. I guess the obvious question is, any idea why the divergence between the live and the feeders today?
We are seeing a little bit of spreading between the two contracts. There's a little bit better demand for live cattle in the front months. No deliveries against February as we're into the delivery season. Cattle weights are coming down. The show list numbers are smaller this week. So we do expect to see a little bit of strength here in these front month cattle futures. Deferred contracts weaker on spread activity. Some of the sale barns are reporting that feeder cattle demand has started to back off, and that has spilled over into the futures market. And so we're seeing some selling pressure, although it's not very heavy. It's a very low volume session.
But still, when you look at the February live cattle, I mean, they're up there around 126 and some change. When the last cash cattle trade that we have seen was more like 123. I think I heard a few that sold at 124 last week.
Yeah, exactly. So we've got a pretty rich premium in. The market's trying to anticipate by the end of February when this contract goes off the board, we're going to see cash cattle much stronger in the next several weeks, and that is certainly possible because of the declining steer weights and the fact that these numbers seem to be dropping a little bit on the show list.
On the lean hog trade, we've had quite a bit of pressure today. We have the April contract down $1.22 at 61.83, May down 128 at 68.55. Here we thought earlier lean hogs turned around. My gosh, they almost went limit up there a day or two ago, and now we're down about half the limit here. How come?
Yeah, that market was just based on some short covering. It was not any strong fundamentals. We took out the previous session highs, uncovering a lot of buy stops, and we went up to nearly fill a gap on the charts, and that gave us so much strength in the futures market, but the cash markets have not followed along, and without any strong fundamentals from a better cash market or any real strong product markets, these futures are left to be sold as the technical trend is certainly down.
Okay, thanks, Brian, for talking with us. Brian Hoops of Midwest Market Solutions in Springfield, Missouri.